Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. We know that the first half of the year was very challenging for investors, but the ETF industry continues to grow at a record pace despite this continued market turbulence. More than 200 new ETFs have launched this year so far, taking the total number of US listed products to over 2,950. So in this episode, we take a look at two new, very interesting, very unique ETFs. In the first part, my guest is Simeon Hyman, Global Investment Strategist at ProShares. ProShares recently launched the first US-listed short Bitcoin ETF, which, as the name suggests, enables investors to short the largest cryptocurrency. So this ETF, BITI, comes at a time when we know that cryptocurrencies have suffered a brutal sell-off, and Bitcoin had plunged below $18,000 for some time. It has rebounded and currently trading close to $20,000, which is seen as a critical level by many experts. So we'll see if that level holds. So in October last year, ProShares had launched the first US-listed Bitcoin ETF. It was a long ETF. So now they offer both long BITO and short BITI. So with Simeon, we'll chat about BITO and BITI. And I'm also interested in his thoughts on inflation and rising rates because ProShares offers 2-3 ETFs that profit from the current market environment. My next guest is Andrew Chanin, CEO of Procure AM. Procure recently launched the first ever ETF that gives exposure to the $2.2 trillion disaster recovery industry. The ticker symbol is FEMA. Now, we have seen a surge in extreme weather events in the past few years: wildfires, heat waves, glacial avalanche, major flooding, and all this is tied to global warming. And the outcome of these events has not only been very costly, but also it's been deadly. So we will talk about FEMA ETF, and we will also talk about Procure AM's space ETF, UFO. We have discussed UFO ETF in the past couple of episodes, so we'll see how that ETF is doing now. Joining me now is Simeon Hyman. Simeon, welcome. Great to have you on the show.
Thanks for having me.
So congratulations on the recent launch of BITI, BITI. It is the ProShares Short Bitcoin Strategy ETF. Can you please tell us how it works and why you brought it to the market?
Sure. BITI is short Bitcoin futures, and the only kind of important thing you need to know here is it's designed to deliver the inverse, the -1 performance of the daily performance of the S&P CME Bitcoin Futures Index. So that daily rebalance is an important element, because otherwise you'd wake up in the morning and wait, am I going to get minus 0.92 today or minus 1.01? So the daily rebalance is the other element to remember.
Yes, you're right. Daily rebalance is very important. So your other ETF, other Bitcoin ETF, BITO, that had a very successful debut, and that was mainly because of pent-up demand. It was the first ETF, first US-listed Bitcoin ETF. So it had gathered over $1 billion in assets within, I think, 2 or 3 days of its launch, and the timing was also perfect. This launched in October last year, and we know that Bitcoin had surged to over $67,000 in November, shortly after the ETF launched, and now we know that Bitcoin is down more than 70% since its record seen in November. So tell us a little bit about the receptivity of BITO and BITI.
BITO is indeed one of the most, if not the most successful, ETF launches with, as you noted, $1 billion in just a few days. And it really was an indication that there was an unmet need. And that's what we perceived at ProShares, that the opportunity to deliver a solution for for investors to get exposure to Bitcoin just in their brokerage account was, something that was just not straightforward to do. Do I go to an exchange? Do I have a warm wallet, a cold wallet? Am I going to lose my key and search the town dump for it? All these things that you read about in the papers that make it a challenge. There was really a important opportunity to deliver a straightforward 40 Act ETF that would allow people to do this simply in their brokerage account. And look, the euphemism is Bitcoin is volatile, but yeah, even an asset like the S&P 500, which of course is one of the greatest sources of wealth generation in the history of world markets, still has volatile and down periods, which we've just seen. So we saw the investor need and the opportunity to introduce the short side with BITI to allow investors the opportunity to hedge exposure and take the other side in times where they might perceive, either a potential downturn in the price of Bitcoin or other portfolio needs for a hedge.
So both these products, BITI and BITO, they use Bitcoin futures. They don't use spot Bitcoin. And we know that the SEC hasn't approved any spot Bitcoin ETF so far, the ETF which is backed by physical Bitcoin. So these ETFs that use futures, they are generally seen as not as efficient as physical backed products because having these derivatives and the need to roll over. So there's another layer of complexity, and they may not be very good at tracking Bitcoin spot prices. So tell us why this is important to investors.
It's really important to investors, and I'll take the opportunity to suggest that the use of futures in the ETFs is, far from a bug, but in fact a feature, and it's really a belt and suspenders approach to delivering investors a really robust way to invest in Bitcoin. And let me explain why. If you look at, and in particularly this year, when as the old joke goes, when the tide goes out, we see how some people are swimming. I won't finish the rest of the picture, but with the decline in Bitcoin prices, a lot of, let's say, quote unquote, interesting things are happening, challenges in the Bitcoin lending market. And then perhaps one of the more chaotic pieces of information that we got was one of the major Bitcoin exchanges actually shared, and it was in their last 10Q, that in the event of a bankruptcy, client accounts may not be segregated and may be subject to the risk of bankruptcy proceedings. So that tells you that this spot market is perhaps not such a robust place to get exposure to Bitcoin, and in fact has a lot of hair on it, to be quite frank. Now, the futures market, in sharp contrast, is evolving and maturing very, very nicely. So first, there are elements of the futures market that are there for investor protections, things like a central clearinghouse, very important in terms of managing that counterparty risk. Liquidity, there's more volume in the CME futures market than there is in the largest U.S. Bitcoin exchange. Very important elements, and even perhaps faster price discovery, which shouldn't surprise anybody. It's like the CDS market in fixed income moves faster than the cash market. So that futures market, if anything, has been maturing versus the spot market that has gotten a bit chaotic. Now, here's the other really important thing, because this inefficiency that people are concerned about in the future space has largely gone away this year. And that comes from what's called roll cost. Because as you invest in futures, every month or every, depending on how your strategy works, as those futures contracts mature, you got to buy the next one. And if the next one's a little more expensive, you're going to incur what's called a roll cost. Well, those roll costs this year have collapsed to almost nothing. So if you look at BITO's performance, it's super close to the performance of Bitcoin, of spot Bitcoin. So you have a futures market with lots of robustness and protections. You have a maturation that's bringing down those roll costs to almost nothing, which is what you should find because there's no storage costs. By first principle, if there's no storage costs, roll costs should be, basically a cash lending rate, almost nothing there. And when you combine the robustness of that futures market with the investor protections in the 40 Act ETF, you have a very robust alternative for Bitcoin investors. And we think that's where BITO's strength has come from in terms of flows and volume. And again, we're certainly pleased to bring BITI to complete the equation. And we are the only ETF provider to offer both sides of the trade.
Right. It's very good to know that BITO has tracked the price of Bitcoin very closely. And as you mentioned, having this ETF wrapper, this is much safer, much more convenient. And you alluded to these disclosures by a major crypto exchange. So tell us, why are there any other reasons to why investors should consider using a Bitcoin ETF versus buying through a crypto exchange?
Well, that the issue of the bankruptcy was, I think, a big one. But also your decisions are not done once you go to an exchange. So you still have to decide where your key resides, whether it's with the exchange, whether you have your own. So you still have a number of decisions to make that certainly add complexity for many investors, and simply the need to have a totally separate account from all of your other investments.
Right. So tell us how investors can use both BITI or BITO in their portfolio.
Well, the debate carries on, if you will. So there is still an important case for Bitcoin to be some version of digital gold, something that will ultimately be less correlated than the other assets in your portfolio. And so certainly some investors will use it, for that reason, for a diversifier in their portfolio. And that, I think, remains an interesting opportunity. Of course, by the way, certainly at this, now that we have seen a dramatic pullback in Bitcoin prices, there are folks who simply view this as a buying opportunity. It's a relatively short history that we can look at for the price action of Bitcoin, but it is indeed recovered from every one of these Bitcoin winters, as folks like to call it. And on the short side, of course, there's the opportunity to simply see a short-term period of decline in Bitcoin performance that one might want to profit from. One might want to hedge existing positions in their portfolio. And as one interesting idea, you might have Bitcoin-related companies that you are invested in, and you might want to isolate their performance from the price of Bitcoin so that you could take BITI as kind of a stapled hedge against the price of Bitcoin to try to isolate your investment thesis on the companies themselves. So there are a number of ways that investors can use both BITO and BITI in their investment portfolios.
That's quite helpful. And I agree with you that some exposure to Bitcoin makes a lot of sense because this is a new technology which will gain a lot of traction in the coming years. But investors should remember that this is a very, very volatile asset class. So they should limit their exposure depending on their risk tolerance. Now, let's talk about spot Bitcoin ETF. And we know that there are many spot Bitcoin ETF in Canada. There are many ETPs in Europe. They are trading well. They have been doing what they're supposed to do. But here in the US, the SEC hasn't approved any spot Bitcoin ETF. As I mentioned earlier, in fact, it has rejected over a dozen spot Bitcoin applications over the past year, including a couple last week itself. Do you expect a spot Bitcoin ETF in the US anytime soon?
So I'm gonna take a pass on forecasting when there might be a spot Bitcoin ETF. But I think what's important to consider are the potential reasons why there hasn't been one approved so far. And again, I'm also going to not try to read the minds of the regulators, but simply to point out what we've been talking about over the last 10 minutes or so, and that is that there are issues and chaotic things going on in that spot market. One would have to imagine that those are some of the challenges that pose a hurdle. Will they ultimately be resolved? Will the spot market mature ultimately? Probably. I don't think we know exactly when that will be. But what we know is that the futures market has already nicely matured. So, there's certainly it's certainly not an investor shouldn't perceive a futures-based ETF to be a second best choice in any way, shape, or form. And we'll see, how long it takes for the spot market to get its act in order fully.
Now, switching gears a little bit, I was also interested in your thoughts on interest rates and inflation because you're a global investment strategist for ProShares. So tell us what you think about inflation. Has inflation peaked? And we just about an hour back, we got the minutes of the Federal Reserve meeting held last month, and policymakers, central banks, has indicated that they will continue raising rates till they are able to tame inflation. In fact, they suggested that we may get either a 50 basis points or a 75 basis points hike in July. So tell us about your thoughts on inflation and interest rates.
There's some signs that inflation may have peaked. As we're chatting today, we've seen over the last several days some notable pullback in the oil market, in oil prices, and this just reminds you that the cure for high prices is high prices, as the saying goes. Now, look, the oil market is volatile, and by the time anyone listens to this, we might have had a rally. But for a little bit of a more stable indicator that perhaps inflation has peaked, is we can just look at the break-even rates. So the break-even rates, and by the way, both say the 10-year and the 2-year on the shorter side, have both receded notably, not in the last week or two, but steadily since April, to the tune of about 75 basis or so. That's a lot, and they're sitting. The 2 and 10-year break-evens are now getting close to 2%. So that's getting close to the Fed target. That may be some indicia that we might get lucky and avoid the dreaded wage price spiral. Now, there's likely still a little bit of room for interest rates to increase because of quantitative tightening. The Fed is removing, and other central banks sooner or later, particularly the ECB, will likely get there too, are removing the artificial suppression over longer term yields. So in this period where we've seen break evens come down, not quite a full percent, but about 0.75%, the 10-year is actually flat. So real rates on the 10-year Treasury have gone up almost a full percent, and they're still really low. So there's still some chance that rates will rise. In fact, I would argue a likelihood that rates will still rise, at least modestly. Maybe not the 5 or 6%, but how about 3.5 or 4, even in the context of diminishing inflation. So that's, I think, a good way to think about where we are with inflation and interest rates.
Very interesting. Now, I know that ProShares offers some products, some solutions that may be well suited to the current environment of high inflation and rising rates. Please tell us about them.
So even in the context of perhaps diminishing inflation, we're still going to have elevated inflation for a little while, meaning it's probably going to be at least a couple of years before we get back to kind of 2%. So in an elevated inflationary environment and with continued rise in real rates, there are a couple of ideas that we think are important. One, we have an ETF, which is ticker EQRR, Equities for Rising Rates, and it's just simply bespoke for this environment. It tracks the sectors and the stocks within them that have the highest correlation to rising 10-year treasuries. And look, it is substantially overweighted to the areas of the market that you would not be surprised to see, such as materials, financials, and energy. And on the inflation side, very, very specifically, we'd also suggest folks take a look at our ETF ticker TOLZ, tolls. And we try to do the tickers to give you a hint of what they are. Tolls is an infrastructure ETF but a very specific flavor of infrastructure. It's the toll takers, meaning the owners and operators of the infrastructure assets. The folks that build infrastructure stuff are super cyclical. But if you own water distribution, if you own roads, if you own cell towers, you have a lot of pricing power. Your customers are sticky. You get to raise your prices, and that can be a very effective piece of a portfolio when inflation remains a little bit elevated. So we'd suggest folks take a look at those two ETF solutions.
Both the products are very interesting, and they have done pretty well this year. Tolls is down just about 2% year to date, and EQRR is down just about 10% year to date, so which is much better than broader indexes. Excellent stuff, Simeon. Thanks so much for joining us today and for sharing your insights.
Thanks for having me. Appreciate it.
So that was Simeon Hyman, Global Investment Strategist at ProShares. Joining me now is Andrew Channon of Procure AM. Hi, Andrew. Welcome back. Great to have you on the show.
Thrilled to be back. Thanks for having me.
So let's talk about this disaster recovery strategy ETF, ticker symbol FEMA. So we know that you conceptualized HACK, which was the first ever cybersecurity ETF. You launched UFO, which was the first pure play space ETF, and that was your first ETF under the Procure AM brand. And now you have launched this disaster recovery strategy ETF. Tell us the story behind FEMA, why you decided to launch this ETF.
Thank you for the introduction. FEMA is, as you mentioned, our newest ETF, but it has been one that has been a long time in the making. And natural disasters are something that affect people around the world on an almost daily basis. It's something that's affected me multiple times in more ways than one, from being a student at Tulane University down in New Orleans during the time of Hurricane Katrina, to being a resident in New York during Hurricane Sandy. And these are very trying times for individuals, for communities, for businesses. And in many cases, these are sometimes our darkest hours. And I'd always kind of wondered, is there a way to create a basket of companies that might see increased revenues during these time periods, because their services are so absolutely needed for many different reasons. You have all types of natural disasters happening around the world. So it is a truly global industry. And then when we started really digging down into this, we started seeing more alarming facts about natural disasters and climate change. And so, unfortunately, over the years, we've seen natural disasters picking up in frequency, intensity, and damage costs financially. And for us, this was something that seemed like, when you look at other kind of thematic industries or trends or whatnot, increased spending on different areas is something that many investors look for. So we worked with VettaFi and others to put together a type of index that could contain companies that are involved in the mitigation, prevention, recovery, rebuilding efforts around the various parts of natural disaster life cycles. And we've seen this come together with just over 60 companies from around the world that specialize in different areas, whether that be preventing floods from being as devastating as they could be, to tracking wildfires, to creating the tools and things that we use to combat these, as well as even down to companies such as Home Depot and Lowe's, which we go to buy plywood for when we hear that a storm's coming, or we go and we have to repair our homes with goods and supplies from places like that as well. So a very well-rounded composition for the underlying index that FEMA tracks, and would be thrilled to dig down to it even more if you're interested.
Right. So unfortunately, we have seen a surge in these extreme weather events, wildfires, heat waves, flooding, and all this is tied to global warming. So these are trying times, as you mentioned, but there is an investment opportunity there. And this disaster recovery industry is pretty large already, and it will continue to grow, unfortunately. So tell us how holdings are selected and weighted in this index.
So we'll take the easiest one first. This is an equal weighted index. So at each quarterly rebalance, the components that are in the index will all go back to an equal weight. So divide by the amount of companies in the basket, and each one should have an equal percentage weight at these rebalance times. It's reconstituted annually, though. So as new entrants come to the market or other companies sell off natural disaster recovery related assets, they can be removed during those times. But really, what the index provider is looking for are companies that are involved in the various parts of the life cycle of natural disasters. That's one of the important parts. Another is looking for companies that may have contracts with agencies such as FEMA or other disaster related types of government entities around the world. And then it also looks for some other things like those types of products that you may need when you do have things like a natural disaster. So think generators and power supply. So there are various keywords that are associated with different types of natural disasters. And these are all things that the index provider is looking to for potential inclusion in the index.
So how big is this industry currently, and are there any estimates for its growth in the coming years?
So it's tough to tell exactly because not necessarily every company breaks out numbers for where they're getting their revenues from. That said, we could look back at historical data, and from about 1980 to the start of this year, there have been roughly about $2.2 trillion associated over that time period from natural disasters. And over the last decade, it's been about, on average, over $400 million a day is what it comes out to. Now, that might seem like a big number, but stretched out over the past 40 years or so, it's a little bit more manageable. However, the White House just came out several weeks back saying that they believe that by the end of this century, the cost to the U.S. budget alone will be roughly $2 trillion a year. And for us, that was an extremely interesting statistic showing that not only does the government believe that natural disasters are going to continue, but the toll financially that they will cause will be significantly more significant than they are now. And to us, as alarming as that is, that also potentially could be an opportunity for people to invest alongside companies that are generating these revenues, in some cases helping to prevent or mitigate these natural disasters, or inevitably when the unfortunate situation happens and natural disasters continue to occur around the world, that these companies may be positioned to help us in those times of need.
So those are very alarming numbers for sure. Now, looking at the holdings in this ETF, these are companies which investors do not usually have exposure to. These are not well-known companies which investors typically have in their portfolios or within their core ETFs. So some of the top holdings include Fujitsu, Middlesex, Tetra Tech, MSA Safety, Rev Group. Could you tell us a little bit about some of these top holdings and what exactly they do?
Absolutely. So Tetra Tech, like you said, might not be a company that many people are familiar with, but they take on all different types of construction and consulting projects around the world. Fairly recently, they've helped Washington, D.C. to upgrade its flood protection systems. So this is a fairly large project that is going to hopefully be able to help mitigate issues from high water levels and flooding in the D.C. area. They've also are helping down in Florida to do things like replenishment of groundwater aquifers. So whether that's the consulting and design or actual engineering and construction, they're a fairly diversified global company that can help in some of these very large scale types of projects. Another company that you had mentioned was MSA Safety. They actually helped build a lot of products that are used for emergency services. So think firefighting, being able to develop things like hard hats and other gear that is used in construction and building, as well as emergency and safety and even life-saving types of scenarios. So, as we see an increased need to help protect from wildfires and other things like that, this is a company that's potentially selling products to these end users. Another company that you had mentioned as well was Rev Group, that many people may not be familiar with, but they specialize in building specialty vehicles. So whether that's fire engines, trucks that have better pumping capabilities, whether that's on ground or in the air, as well as ambulances and other types of first aid and life-saving vehicles, this is a company that is providing these very needed heavy machinery and equipment to specialized companies, municipalities, or groups that help in the recovery efforts and beyond.
So tell us how investors should use this ETF in their portfolio. Should they buy it after a major climate event, or should they make a small allocation now, since we know that these, unfortunately, these events, the number of these events and the severity is going to continue to rise, and the need for these products and services which are being produced by these companies will rise in the coming months, coming years?
So I'm not allowed to make projections or price targets or recommendations, but I think one of the exciting things of building this product was realizing that this could be something that could be of use for many types of investors for all different types of reasons. You may have some people that look at some of those trends that we mentioned, like the rising increased costs of natural disasters, and say, okay, well, if more spending is going to be going towards companies that are aiding us, whether that's government and relief agency contracts, whether that's companies trying to better build up their own capabilities, that they're able to remain responsive and not have outages for their own business continuity. Or it's individuals that are looking to either repair from a devastating storm or do something to take preventative actions, like buy generators or other equipment that make their home more stable and protected to withstand these types of disasters. There are all types of reasons that people may look at this, whether, like we said, it's that the rising cost to recover from these. It could be a hedge fund that says, hey, we are looking to make a tactical trade based on a particular catalyst that they might see coming down the road. Or maybe even an insurance company that's saying, hey, when these major events occur, we need to typically pay out significant amounts for recovery to our clients. Depending on how this performs during various types of natural disasters, this may be something that insurance companies or others, depending on their business structure, might be looking at considering. So this wasn't necessarily a product designed for retail investors or hedge funds or what have you, but I think it does have the potential to check a lot of boxes for different types of investors, depending on what their various goals or investing theses might be.
That makes a lot of sense. And now switching gears a little bit, I also wanted to talk about your space ETF, which is one of my favorite ETF tickers, UFO, and also one of my favorite ETFs because this is such an interesting space. This ETF is down about 34% over the past year. And we know that this is an emerging industry, and some of these emerging technologies are still in development stage. Many of these new companies are not making any profit as of now. So in a raging bull market, investors love these type of stocks, which have a lot of growth potential, which are sort of speculative stocks. But now when interest rates are rising, inflation is rising, and monetary policy is tightening, so there is very risk tolerance for these type of stocks. So do you expect space stocks to rebound anytime soon? And anything else that is happening in that space, please tell us about UFO ETF.
Yeah, so we have seen numerous companies rebound on their own schedule during this recent market sell-off that we've been experiencing over the last many weeks. So some of these catalysts have been government contracts. So many times when people look for things to invest in when you could have a downturn or a recession, sometimes people look for companies that have stable and steady revenue streams, and in some cases those come from government contracts. We actually saw several companies in the fund just recently receive fairly large contracts for imagery services from the U.S. government. From what we saw with the ongoing fallout from the Ukrainian-Russian conflict, is that space is extremely critical for so many reasons. Before the actual invasion started, a company like Maxar, which actually happens to also be a FEMA holding, as well as a UFO holding, is a company that was providing satellite imagery of what was going on the border of Ukraine, and showed before the actual invasion started the buildup of Russian troops and supplies on the border. Well, similarly, they also help us understand weather patterns, track storms and wildfires and things like that. And so it's extremely critical for natural disasters as well. But what we've realized is it's not just satellite companies that are providing imagery that are important for warfare these days. It's also things like defensive capabilities, communications, and even as our space technologies expand, even offensive capabilities. And we've seen a lot of advancement across the space industry, particularly from China. And space is something that the U.S. government has fully acknowledged on all sides of the aisle, that space is something that we can't just let another country or group take the leadership role in. And for many strategic as well as security reasons, the United States needs to be a leader in space. And when you look at any of the other areas of warfare, whether that be land, sea, air, cyberspace, and now outer space, the way that the U.S. military tends to maintain a dominant standing is by outspending its competitors. So there's a tremendous amount of need as well as demand from the U.S. government and the military to be investing in, supporting, and contracting companies that are able to help it achieve its various space goals. And UFO is a diversified basket of over 40 companies, publicly traded companies from around the world that are specializing in various areas. And another area that's also benefited from what's been going on with Russia is that companies in need of launch services are now starting to say, I don't know if I can necessarily rely on using a Russian solution. And that's opening up many new opportunities for launch companies such as Rocket Lab, Astra, through the United Launch Alliance, which is a joint venture between Boeing and Lockheed Martin. In Europe, you have a company called Avio that specializes in launch as well. These are all companies that could potentially be beneficiaries of increased demand for launch capabilities, especially given that Russia is only been more closing themselves off from the commercial space industry since the conflict arose. So, it's difficult to say what the entire industry will do, but we've seen many encouraging signs, as well as very large contracts and multi-year contracts that have been awarded to many companies across the space industry, and particularly many that are holdings within UFO.
Excellent stuff. Always enjoy chatting with you, Andrew. Thanks again for joining us.
Thanks so much, Nina. It was a pleasure. Happy to join anytime.
So that was Procure EAM CEO Andrew Chanin. That does it for this week's episode. Thank you so much for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zax.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.